Hello and welcome back to The Note. There is a fascinating debate going on over trade policy at the moment. Our own eminent economics blogger Gavyn Davies has argued that the falling share that trade takes in global GDP is a bad news for the economy, and the rival economics blogger for the New York Times, Paul Krugman, made a very interesting riposte suggesting that the importance of trade can be exaggerated. Where is the truth? Well, today I get to play the part of Paul Krugman, and my guest today is our blogger and also the principal of Fulcrum Asset Management, Gavyn Davies. Gavyn, thank you very much for joining us once again. Let's start by taking a look at one of the main points you made in your blog, which is that world trade growth certainly over the last few years does look like some kind of a geared relationship to global GDP growth. What's going on there?
It always does have a geared relationship, John. I think the problem, though, is that recently, as you can see here, the growth in world trade has been almost zero for quite a long period of time. This is volume, by the way. And it shouldn't have been that low given what has been happening to global GDP.
Right.
So something seems to have happened to the trading mechanism. Is it protection, or is it the euro crisis, or is it the BRICS crisis? We don't know yet, but I am worried that the growth in world trade has been too slow relative to GDP, and that could have feedback effects into the growth process.
Now let's take a look at that ratio put out very, very clearly. There has been that very steady growth in the ratio of world exports to GDP during a long period of expansion. You think these are related, right? That the more trade that goes on, the better for GDP?
Yes, I do. I mean, I think there's a couple of things here, one of which Paul recognises and the other which I think he denies. As world trade expands rapidly, resources are able to be put to their best use around the world. Comparative advantage works well. That's one gain to productivity and to GDP.
And that's almost constant, isn't it?
Yes.
At any point in time, that would be true.
But the more trade we have, the better it gets. And I think that's part of why we have benefited from this increase in the share of world trade, the share of GDP that world trade takes up. And Paul says, yeah, that happens, but it's not a very big effect through time. My view, though, is that there are other effects. So as trade grows, there are economies of scale which countries can take advantage of, which are not included in Paul's arithmetic, I think. Right. And there are also eliminations of inefficiencies. Monopolies become more difficult to sustain, etc. So my view is that the impact of trade on GDP is bigger than Paul's numbers are showing.
Okay, now let's take a look at the latest forecasts to show why we're talking about this, why this matters. The IMF has recently very sharply downgraded its forecasts for growth in a number of emerging markets. I think the Paul Krugman argument would have been that we had a number of one-off changes, such as the growth in emerging markets, which is now over, and also such as containerization. Is there some truth to that? And do you agree with this very much more bearish outlook that we've got from the IMF?
Well, there is some truth, obviously, to what Paul says. I mean, there have been special factors boosting world trade, especially regarding these countries, which now seem to be running out of steam. But is there more protection going on, protection by stealth? I would say perhaps there is. And the other point I would make is if you look at the cumulative downgrades to China and India here, they are of the order of 10 percentage points of GDP by 2016. I don't think all of that is cyclical. I think that some of that actually is because the trade benefits are beginning to run out of steam. And that means, I think, that these countries are going to grow less rapidly going forward, not just over this period, than we've become accustomed to in the last decade.
Okay, Gavyn, thank you very much indeed. I think the bad news is that we do seem to have an agreement that the period of explosive growth for emerging markets is over, and that's still not always widely understood by markets. I suppose the good news is that there is more agreement between our own eminent blogger and the New York Times' eminent blogger than at first appeared.